Wall Street is quietly preparing for a shift that could completely change how passive investors make money in 2026. It is not about chasing hot stocks. It is not about timing the market. And it is definitely not what most financial influencers are shouting about right now. What is coming favors patience over panic and strategy over speed. If you are a passive investor or someone who wants to invest without stress, this might be the most important message you hear this year. Why 2026 is different for passive investors. For years, passive investing followed a simple idea. Buy broad market funds, hold them for decades, ignore the noise. That still works. But Wall Street believes 2026 will reward a smarter version of passive investing. Big money institutions are adjusting quietly. Pension funds, insurance giants, sovereign wealth funds. They are not abandoning passive investing. They are refining it. The reason is simple. The world is changing faster than traditional indexes can adapt. Inflation cycles are shorter. Interest rates are more unpredictable. Technology is reshaping entire industries almost overnight. Passive investors who understand this shift early could benefit far more than those who blindly follow old rules. The silent rise of smart passive strategies. Wall Street analysts are increasingly talking behind closed doors about something called intelligent allocation. This does not mean day trading. It does not mean complex charts. It means passive investing with awareness. Instead of holding one single index forever, institutions are quietly rotating between asset classes based on long-term data, not emotions, not headlines. This approach is expected to dominate passive portfolios in 2026. Examples include adjusting exposure between equities and bonds based on valuation levels, increasing global diversification instead of focusing only on the United States, adding alternative assets without excessive risk. Retail investors rarely hear about this because it sounds boring, but boring is exactly what builds wealth. The index funds Wall Street is slowly moving away from. Here is something few people are talking about. Some classic market cap weighted indexes are becoming dangerously concentrated. A small number of mega companies now control a massive percentage of major indexes. If those companies struggle, the entire index feels it. Wall Street is not panicking. They are adjusting quietly. In 2026, more institutional money is expected to move toward equal weighted index funds, factor-based passive funds, quality-focused indexes. These still follow rules. They still avoid stock picking, but they reduce dependency on a handful of companies. This shift could protect passive investors during unexpected downturns. Why global markets will matter more than ever. For a long time, United States markets dominated passive portfolios, and for good reason. But Wall Street predictions for 2026 suggest something interesting. Global diversification is becoming essential, not optional. Emerging markets are maturing. Some developed markets outside the United States are trading at much lower valuations. Currency cycles are shifting. Large institutions are gradually increasing exposure to Asia, parts of Europe, and selective emerging economies. Not because of hype, because the numbers support it. For passive investors, this means one thing. Staying only domestic could limit future growth. The smartest passive portfolios of 2026 are expected to spread risk across borders quietly and consistently. The real role of bonds in 2026 portfolios. Many investors lost faith in bonds recently. Low returns, inflation pressure. Wall Street does not see bonds as dead. They see them as misunderstood. In 2026, bonds are expected to play a smarter role, not just income, not just safety. Institutions are using bonds strategically to reduce volatility, protect against deflation shocks, provide dry powder during market stress, short-duration bonds, inflation-linked bonds, global bond exposure. Passive investors who completely ignore bonds may face unnecessary risk. The future is not stocks versus bonds. It is balance and timing based on data. The quiet expansion into alternative assets. This is where things get interesting. Wall Street has been increasing passive exposure to alternatives for years, but retail investors rarely notice. By 2026, alternatives are expected to be a standard part of passive portfolios. This includes real estate investment trusts, infrastructure funds, commodity-based indexes, not speculative, not exotic, These assets often perform differently than stocks and bonds. They can protect purchasing power. They can smooth returns over time. The key is controlled exposure, not aggressive betting. Wall Street knows this. That is why they are positioning early. Why cash is no longer trash. For years, holding cash felt pointless. Inflation ate it away. That story is changing. Wall Street predictions for 2026 suggest cash will regain strategic value. High-interest environments reward patience. Cash allows flexibility. Cash reduces forced selling. Institutions are holding more cash than they admit publicly, not out of fear, out of preparation. For passive investors, this means something powerful. You do not need to be fully invested at all times to win. Sometimes doing nothing is a strategy. The automation advantage no one talks about. Technology is quietly transforming passive investing. Robo-advisors, automated rebalancing, tax optimization algorithms. By 2026, Wall Street expects automation to outperform emotional decision-making consistently. Not because machines are smarter, because they are calmer. They rebalance without fear. They harvest losses without hesitation. They stick to rules relentlessly. Passive investors who embrace automation could outperform those who constantly interfere. The future rewards discipline, not intelligence. The psychological edge of passive investors in 2026. This might be the most overlooked prediction. Markets are becoming louder. Social media amplifies fear. News cycles never sleep. Wall Street believes passive investors will gain a psychological edge. Why? Because they react less, because they panic less, because they focus on systems, not stories. In 2026, emotional investing may become the biggest risk factor. Passive investing is not lazy, it is emotionally intelligent. The big mistake Wall Street thinks retail investors will make. Here is the uncomfortable truth. Many retail investors will abandon passive strategies right before they pay off. They will chase trends, they will follow influencers, they will overtrade. Meanwhile, institutions will stay patient, boring, consistent. Wall Street predictions suggest the gap between disciplined investors and impulsive ones will widen. The biggest enemy of passive investing is not the market. It is impatience. How to position yourself for 2026 without overthinking. You do not need insider access. You do not need advanced math. Wall Street strategies often look simple from the outside. Focus on diversification across assets and regions, regular rebalancing, low costs, long-term commitment. Avoid complexity disguised as intelligence. Simple strategies executed consistently beat complex strategies executed emotionally. Why fees will matter more than returns in 2026. One of Wall Street's quietest warnings for 2026 is not about market crashes or bubbles. It is about fees. When returns become moderate, costs become louder. Even a 1% difference in annual fees can erase years of progress over time. Big institutions already know this. That is why they are aggressively moving capital toward ultra-low-cost passive funds. Retail investors often ignore this because fees feel small. But in long-term investing, small leaks sink big ships. In 2026, controlling costs may matter more than picking the right asset. Passive investors who focus on expense ratios, tax efficiency, and turnover rates may quietly outperform others without taking extra risk. Why volatility is not the enemy. Most people fear volatility. Wall Street does not. Volatility creates opportunity for disciplined passive strategies. Automatic rebalancing works best when markets swing. Regular investing benefits from price fluctuations. In 2026, analysts expect higher short-term volatility but stable long-term growth. This environment punishes emotional reactions and rewards calm systems. Volatility only hurts investors who panic. Those who stay invested and rebalance methodically often benefit without realizing it. The compounding effect everyone underestimates. Compounding is slow at first, almost invisible. That is why most people quit early. Wall Street projections show that passive investors who stay consistent through 2026 and beyond may experience accelerated growth later. Time is the multiplier. Patience is the fuel. The real payoff comes after most people stop. Paying attention. This is why institutions think long-term while individuals think monthly. And this quiet difference changes everything. The final truth: Wall Street will never say out loud. Here is what no one openly admits. Most wealth is built quietly, without drama, without viral posts. By the time headlines celebrate success, the work was done years earlier. 2026 will not reward those who shout the loudest. It will reward those who stayed steady while others panicked. Passive investing is not about being early. It is about being consistent. Wall Street already knows what is coming. The question is whether you will act before the crowd notices. If this opened your eyes, imagine what staying disciplined for the next few years could do. Like this video if you value smart investing over noise. Subscribe for more insights that Wall Street does not advertise. Share this with someone who needs clarity, not hype. Because the smartest moves are often the quietest.